SoFi, we're going to look at their member growth. We're going to look at their numbers. We're going to look at everything from Q2 of 2020 to Q3 of 2022. I cannot find a single filing that's earlier than Q2 of 2020. Gives us the longest picture that we can see, because these are the types of things that I like to look at. I mean, first, let's talk about members. I mean, it's contentious on whether you want to talk about whether these are still daily active users, monthly active users, whatever. I mean, it is a cumulative number, but still, we have seen almost 300% growth in our members in the last 2 years and 1 quarter. Products grew even faster than that, 300 and nearly 40%. Lending up almost 50%. Financial services up 655%. And our tech platform, after we bought Galileo Technisys, is up 245%. Whenever we look at the individual products, like you can obviously see, a couple things already stand out. Personal loans, large amounts of growth. Home loans, actually, surprisingly, large growth. Student loans, you'll see how, although there is growth, it doesn't look this pretty over this amount of time. We'll actually correct that. SoFi Money, SoFi Invest, unbelievable growth, 800%, 530%. Credit cards and referred loans, which is Pagaya, are both new, so they didn't actually have anything before this, okay? And then, Relay and Atwork, obviously just growing at insane rates again, 600 and 750% respectively. How many members can we actually go after and try to monetize? That number is going up dramatically. Whenever we start looking at the finances, just the first little snippet here, okay, I wanted to just look at net revenues, net incomes, the ratios between them, and then adjusted EBITDA. Now, this is for Q3. I wanted to highlight this. I just wanted to show this because it's a little bit more on curve. Net revenues up 111%, and the net losses are actually increased by 73%. Obviously not great, but this ratio is here to show you that we are closer to profitability. Once we hit 100%, that's profitable. And then everything after that is actual gains, right? And then we start to pay taxes. Adjusted EBITDA is growing, which is absolutely great. But now, obviously, that's supposed to happen. We have a bank charter, and that's going to continue to grow and at a pretty good clip until everything is actually gone through the bank and we're starting to get those everything done, which is going to take another probably like 2-3 quarters to actually finalize. Let's jump into actual student loans and see all the different finances that we can look at here. I know it's a lot. I tried to reduce it down to as little, statistics that still get you a good picture for what's going on. It's bad. For student loans, it's bad, guys. Origination volume shot down 42%. The FICO scores about the same, not really a change there. I didn't put a growth percentage on negative or positive for FICOs because it just doesn't matter. For example, if a FICO is 900 and you reduce it by 50, it goes down to 450. That's not a 50% decline, right? You can't go from a perfect credit score down to 450 and that be a 50%. It'll be like, nearly 100% decline. So it doesn't really work that way. So let's reduce, the percentage used. Our average interest rate earned down 14%. The income recognized has grown because we're holding more on our actual books. And you can see that because the sale of loans is way down, right? 90% decrease. Defaults are climbing 0.1%. Total weighted average. This is the amount that it actually makes up for our loan department for SoFi. So before, we were dependent on student loans by 46.55%. Now that's reduced to 25.9%. Okay, a 44% decrease on our dependency for student loans. Average loan balance for student loans obviously decreasing because people are paying off their loans and we're not getting new loans back. So it's just, decreasing, obviously. And then potential interest is a calculation to show how beneficial our loans are depending on whether we're going to sell them or hold them. So this is factoring in everything from default rates to, the loan balances to the interest rate earned. So our student loan value is actually decreasing over time. Not great.
But so I guess my question is, why is it that bad for us if we had a year without it, we still are able to grow? I mean, obviously it's not good, but if we're not really factoring it into our projections, is it really that bad or is it just not a net positive?
Well, here's the thing: is that SoFi was back and forth on this. They said they were not factoring in student loans into some of their quarters, and now they are. Like Q4, for example, our upcoming quarter did factor in student loans coming in at the tail end of the quarter. Now they're not coming. So we're almost expecting a underperformance on our next quarter because of student loans not being there. So if SoFi does outperform, it's going to be a party on Wall Street, or at least that's what I'm suspecting, because it was a large portion of our business, 46%. It stopped growing for the longest time. These percentages, they tell a pretty clear story. You know what I mean? The only thing that rose on this entire thing was default rates. That's that's not the metric you want to grow. So our entire home loan business down on this section right here, origination volume absolutely shot. Our FICOs, once again, they're lowering. They're still in great ranges, but I can't show a percentage for that because it just wouldn't make any sense. But our interest rate earned is growing like crazy, and this is only on the the last couple of quarters that we're actually seeing because the Fed rates are really high right now. So the home loans have risen a lot, and that means that our interest that we're taking home from our home loans is going up a ton. That's very, very exciting. Because we're a bank now, we're holding all the loans on our book. There hasn't been a large amount of sales. This is just specifically in the quarter of Q3 2022. Default rates stayed stagnant, awesome. And total weighted average for home loans has climbed a ton, obviously, because of those interest rates. We're earning a lot more. Sorry, 600,000 to 1.5 million. All of this leads to a potential interest. Like I said before, the quality of the loans. This shows how much we could sell these loans for. Obviously not that number, but the ratio of increase does show that these loans are more valuable to investors because default rates did not climb, but the actual interest rate did climb a ton. So it's more interesting to investors to buy these loans from us, but it's also more interesting as a loan for us to keep it on our balance sheet. So both absolutely amazing.
I expected it to be worse, honestly. With the interest rate environment being where it is, like student loans obviously had the moratorium, and then home loans just had the macro. Obviously, we're going to see a very different picture when we scroll down and probably see personal loans, for the next year. But I expected it to be worse personally.
It's just the writing of new loans. This is the problem, and where they just say that our partners for our home loans are just not succeeding the way that we thought they would. Personal loans, origination volume speaks for itself. So we were not a student loan business back in the day, really. I mean, that's actually not true. It still made up for nearly 50% of our overall business. Now it makes up 65% of a much larger business, 450 million to 2.8 billion. So that's 525% increase. FICO scores are lower, but still very much within our margins. Our average interest rate earned is up, okay? And a lot. That's very, very exciting. Up 17%, okay? Interest income recognized is incredible, up almost 220%. This is also because we're a bank now. We're holding these loans longer, and we're also selling a lot of loans too. We're also funding a lot of our new projects, funding more growth for our loans through selling a ton of loans here. Now, if I actually look on a quarter over quarter basis, if I remember correctly, it wasn't nearly as much that we sold from last quarter, but still looking all the way back from then, it's a massive increase, 263%. Default rates have been climbing from this point. This is sort of what the bears are saying is sort of the problem here. Now, my counter to that is that we also increased the interest rate earned by 1.8%. So that's the very exciting thing, is that for every loan that we lose, we're getting that money to pay for those losses. So hopefully that those interest rate earned will be able to obviously fund the unsecured part of our loans. The actual balance of the loans are getting larger. This is also helping with the amount of interest earned. And then the potential interest. This is factoring in the increased amount of interest rates, the default rates, the loan balance. It's skyrocketing, going way up 106.7%. Very, very exciting. This is our financial services. This was not the same business 2 years ago, obviously. It's a very new product back then. These are unbelievable growth rates. And I'll show you, because this sounds like a small portion of our business, but I'll show you how much that's changing going on in the next one. So
Do you think that's sustainable, these growth rates?
I think that we're still looking to keep up a 150 or 200% CAGR going forward. So I do think that there is a large growth rate that's still going forward. Our money products, our invest products are still by far our fastest growing products. And so I do think that this will be the fastest growing industry. I don't know if it'll keep up these growth rates. These were, some incredible changes, but yeah. Technology services. This is Galileo at its infancy to Galileo to where it is today. But we owned Galileo back then. These are the numbers that they were putting up whenever we bought it for $1 billion, $1.2 billion. Now it's putting up numbers closer to these. I mean, this is also factoring in Technesis, but Technesis is tiny. I mean, really, really small. This is not only Technesis's business, but the software licenses is not Galileo. That's Technesis. It's a joke. Payment networks, this fluctuates like nothing you've ever seen. I mean, one quarter it'll be 600, the next it's 100, and back and forth, back and forth. I wouldn't trust these numbers, too closely. Overall, though, this business has 4x'd itself in the past, 2 years. What I'm looking at here is the total potential interest for all the loans and everything that we've looked at. So our total loan value in terms of how much more exciting it is for us to hold the loans or even sell the loans technically should be 57% more exciting, but that's without factoring in how much it costs us to fund these loans. So I did a little research and looked at warehouse facilities, warehouse interests, how much we've changed during that time, and then also deposits. We didn't have deposits back then. We do now. These are interest paying deposits and how much we're actually paying for those deposits. So we're paying, 2.9% for our warehouse facilities, 1.5% for our deposits. And that means that the difference in how much we're actually taking to fund these loans has increased by, 95%. Factoring that all in, including loan loss ratios or loan loss provisions of what we're looking at, our loans technically, including everything, has gotten better by just about 4% between that time and this time. Now, obviously, the total book value of how much loans we're holding has increased dramatically. So the fact that we're even increasing on the loans is a pretty interesting story. This earliest filing that I could find are diversification. So financial services, 2%, 14% for technology services. This is revenues, okay? Lending makes up 83.6%. On the other side, we have where we are today. This shows a pretty interesting story about our diversification. Our financial services has exploded during this time, most in recent quarters, and hopefully looking to continue. Technology services has grown, and the lending, our dependency on our lending department is shrinking. So this is what I talk about with this idea that if things are going to get worse, that we're too dependent on lending. And I mean, 69% is a lot. It's still very, very dependent, but it is getting a lot better. So this is what I mean, that the longer that this takes, this doom and gloom to happen, hopefully the safer that we are, because by 2025, the idea is that SoFi is going to be a 30-30-30 split, right? Technology services, financial services, lending, and we will be very diversified.
And look, one thing I will add to that, just like as a devil's advocate, is that one thing that contributed to this 83 to 69 is student loans being kneecapped for so long. But the other side of that is that that's been counteracted with personal loans receiving this huge lift from the Fed, basically. So you could argue sort of both sides.
Why don't we look at, because I know there's a lot of people, people that I've definitely spoken to that have bought in this stock back whenever it had SPAC'd, but IPOE or whatever it was called. What was the market cap back then and where are we today versus all of these statistics that I showed you? The large personal loan growth, the large financial services growth, the technology growth. And I think people are worried about the recent term of the technology services, but don't give it enough credit for what it's done, during the pandemic era, where it's just exploding with new contracts. Right now, it's not a very popular thing for neobanks to come out. And now what we're trying to do is go after the big guys. So hopefully we're going to see an explosion in technology services. I'm not going to believe it. I'm going to be pessimistic with how many actual contracts that we get. Once I see even one great contract, like Palantir getting the US Army contract, then I know that it's a very serious product. Take it with a grain of salt, knowing that Noto says that this is the best product in the world. Find me a CEO that says that their product's not the best product in the world. You know what I mean? But I just want to show you guys the difference in the market caps here of the business. At the time that we went public, it was $21 billion. Today it's $4 billion. Or
wow.
Q3 2022 was $4 billion, an 81% decrease. I think that there were some numbers on there that didn't look great. I think there's some numbers in there that look phenomenal. I don't think it's an 81% decrease. And now I got to give a shout out to Chris Hager, where he showed off that this is not a SoFi only, collapse in the stock market for fintechs. This is across the board. Every company, including Warren Buffett's companies like Ally Financial and Nubank, are dropping like crazy. Is it a macro environment? Is the entire industry destroyed? Or is it just a rebalancing? Very weird things can happen in public markets, So I don't know. Whenever I start to see the numbers change for SoFi, I'll be the first ones, to ring the alarm bells. But for now, I see great things. I'm confident to keep investing. And I feel like, what's the difference between this and whenever Amazon dropped 90%? They were showing great numbers. The CEO came out and gave a strong letter. Anthony Noto's not being loud enough about the love for his company, except he's putting his money where his mouth is, right? And maybe that's even stronger than a shareholder letter. I mean, maybe it is.